What's going on, my fellow wealth creators? Matty Guys here. Welcome to another training. Today, I want to do a full breakdown of my very first infinite banking policy and how I set it up. I'm going to actually show you the illustration that I used when I got approved. It's exactly what I got approved for, which was awesome. And I want to break this down. There's a few points, specific points that I want to break down and show you, like, the cash value that's available in the first year, the break-even point, when the policy starts growing by more than what I put in, just all the other benefits that you can get from this policy, so that you guys can get an idea of what a properly structured dividend paying whole life insurance policy looks like, specifically for infinite banking. And here's the thing, is that you don't necessarily have to set your policy up exactly the way I'm going to describe. At the end of the day, the way we structure these policies really comes down to our own specific goals and situations. So the way I set mine up might not make sense for you, but usually what we're looking for, if we're trying to implement infinite banking in our lives, is high cash value and maximum efficiency, right? Plus, we get all the other benefits as well. But in this video, I want to show you a real policy. We're going to look at my actual illustration, hopefully give you guys a good understanding about policy design, so that you can have a more educated and just overall more productive conversation with your agent. All right. So I'm going to go ahead and share my screen and let's get into it. All right. Let me zoom in here a little bit for you guys so you can see a little bit better. All right, cool. So here I am. It's my policy. 35. I got the best rating, fortunately. It does help a little bit with efficiency, but even if you don't get, if you get a standard rating or preferred tobacco, whatever, these things can still work really well. Now, here's the thing. Here's what I want to start with, guys, is I structured my policy with a 25% base and a 75% paid up additions. Okay. I go into more detail about those things inside of my Infinite Banking University. You can get access to that in the description if you want. But basically, you can control where your money goes inside of a policy, whether it goes to base premium, which is going to give you more permanent death benefit, but you're not usually going to get any cash value out of that, especially in the first couple of years. Eventually, it comes back to you in the, with the guaranteed growth and dividends. It comes more and more of that shows up in cash value. But if you're looking for high cash value, you want more money in the paid up additions, right? That's like, we don't really need to know. It's kind of like a mini paid up whole life insurance policy in and of itself. All right. But just the most important thing you need to know is when you put money into paid up additions, most of that, usually like 90 to 95% of that, shows up in cash value immediately. All right. So for maximum efficiency, high cash value, we want some kind of split like that. Again, it depends on what you're looking for and what your goals are. But that's how I set mine up. Now, the other big thing here that you'll see too is in my first year, I put $120,000 in. All right. And up here, you can see a breakdown of it. The first portion of it covered my first year's premium, which is going to be $25,000 per year. And then I did a lump sum of an additional $95,000. Now, there's a couple of reasons I did that, guys. Number one is max cash value. Like when you do a large lump sum above what your annual premium is, you typically see a lot of that in cash value. Okay. So if you can, what I usually recommend is doing a minimum of like double your annual premium, whatever you set that up as, in the front loaded lump sum. In this particular case, here, we'll go back to my screen. In this particular case, I did, I don't know, what is that? Almost 5 times my my annual premium, right? That really kickstarts the compound growth. It gives us access to a ton of cash value. You can see here, out of the 120, I have almost 113,000 in net cash value, and then I have access to borrow against about 90 to it's like 93% of that, give or take. So plenty of liquidity. And here's the thing, guys. Here's the other thing. If we look at year 2, all right, I'm putting in 25,000. Now, again, 25% of that is base. Comes out to about $6,200 per year is like the bill I actually get, even though I don't think of this as a bill. I think of it as depositing money into my own bank. But and then the rest is at my discretion in paid up additions. All right. So there's a lot of flexibility in this policy. But look at this, guys. The increase in net cash value is more than what I put in the second year. That is really, really powerful, guys. So I'm putting 25,000 in, but I have access to about 27,000 of it. So, if we look out even further, year 5, I put in 25,000. the net cash value grows by 31,000. Like, so it's a really, really strong policy. The sooner you can get to this point, the better. The typically the more efficient the policy is. Right, so really powerful. And then also my break even point. So by year 4, I put in 195,000 total, and my net cash value is more than what I've put in. So a really, really early break even year. And those are kind of the 3 things that we want here in the very beginning. We want high cash value in the first year, so we have that liquidity to invest in our businesses, invest in real estate, have an emergency and opportunity fund, et cetera, whatever it is that you're setting it up for. One of the first things I did, I made a large capital purchase. I purchased my vehicle, and then I did another policy loan to invest in my business. But what's great about this, guys, is, and I talk about this in my Infinite Banking Masterclass, but all that the money I used to purchase my vehicle is still compounding in my policy right now. And I've got to pay that policy loan back, which is fine. There's going to be a little bit of interest, but that liquidity gives us so much more opportunity, and it eliminates all of the a huge portion of the lost opportunity costs, which is one of the major benefits of these policies, guys. So if you can get high cash value, early break even year, and your policy is growing by more than what you put into it early, if you can hit those 3 things, then you've set up a really efficient policy, guys. And so I was really happy with the way this turned out. Okay, now to break this down a little bit more, I also did a 7-year term policy. That's what this is right here. See this rider? This is a 7-year term policy. Oops. I probably would have done this a little bit longer, but my goal with this is I'm going to convert this into another policy at some point. Once it expires at year 7. I can't do it before that. Otherwise, the policy will MEC or become a modified endowment contract. But in order to have these max funded policies, you do have to usually have a term policy on there, which raises the death benefit so that you can avoid the policy becoming a MEC, all right, which is where you would lose all of the tax advantages, which we don't want. And so what you'll notice here on the right-hand side, my death benefit, it drops off pretty significantly in year 8. So if I were to do this again, I'd probably do like 10, maybe 15 or 20 years on the term, because I actually do really like having the death benefit. I think that's a really important thing for us to have in our lives, especially when you have family, kids, loved ones that depend on you, et cetera, causes that you support, whatever. This stuff is really powerful, guys. But that's why my death benefit falls off right here, because the 7-year term policy falls off. From there, I don't need the term at that point because I'm past the 7-year pay mark for the MEC or modified endowment contract test, whatever, 7-year pay test. So I could have extended that a little bit more, but look, everybody is different situation. One of the reasons I didn't do that is because I knew I was going to do another policy anyways, and I wanted this to be as efficient as possible. So typically, the lower your term for the shorter the term is for the term policy, the more efficient the policy will be in the long run. Usually the higher your internal rate of return, net internal rate of return will be, because you don't have the cost of that term dragging the efficiency down on the policy. But again, I'm not saying that like it's a bad thing, because to some people, death benefit is really, really important. So it can absolutely make sense to have a longer duration term policy on these. So just keep that in mind. Now, some of the other things that I want to point out here, we'll just scroll down. We'll look at the later years. I actually set my policy up to be paid until 75. That was a personal decision for me, because the way I think about these policies, like I mentioned earlier, is I don't think of this as another bill or expense in my life. I think of it as a deposit into my own banking system, right? Because I have almost instant liquidity to it. Plus, it's going to start growing by more than what I put into it every single year. Like, why on earth would I really want to stop putting money into this thing? Now, for my next policy, my second policy, I'm doing a 20 pay. And I did that just so I'll be paying that until I'm 55. And it's because I already set a policy up like this to pay until I'm 75. And then again, also as my income adjusts, then, I might, the next policy I set up after that, I might do till 75 again. Like it just depends on your goals and your situation, guys. All right, so but this particular one I'm paying until 75. You'll notice here that the premium payment changed as well. Like at the year, my death benefit dropped off. Again, that's because the 7-year term policy expired. We didn't need that anymore, so that's why we're at 24,395. Now, the other thing I want to show you, it might be a little tough to see, tough to find because this was like my the documents for like my actual application here. Let me see if I can find it for you guys. 1 second. All right, here we go. This is what I want to show you. I wanted to see you to see the actual numbers for the policy breakdown itself. Like I said, I did a 25-75 split. So 25% of my premium goes towards base. And I did that because like I don't really like going lower than a 25-75 split. I know people that do like 10-90 splits, like for super max cash value. I like having more of the permanent death benefit in the beginning. You get a little bit of higher dividends in the beginning as well, et cetera. Like there's pros and cons to each. Most of the time, though, with these mutually owned life insurance companies, as long as you do a lump sum up front and you structure it similarly to this, the net internal rate of return is going to be very similar across the board for a lot of these companies. It's not really why I set my policy up, even though it is a major benefit. But I like doing 25-75. So you can see here the annual premium plus the term rider. 62.49. That's what I'm on the hook for every single year. The 18,000 right here is the paid up additions, but this is at my discretion. So if 1 year I'm just maybe my cash flow is down, my income's down, my business is really suffering, whatever. Life happens, and I don't have the funds to pay the 18,000. I don't have to. I'm on the hook for the 6,200 right here. And again, it also depends on when this happens because your dividend might cover it. You can take a policy loan to cover it, whatever. So there's other options. My point is there's flexibility within these policies. So don't feel like, like in this case, I'm not on the hook every year for 25,000. Now, with that said, I always recommend setting up these policies so that you don't really have to think about it. Like it shouldn't be stressful to you. It should be something that fits within your current financial situation and that you're pretty comfortable paying long term into the future. Because again, we want to set these up for max efficiency, and how that happens is not just in the beginning, not just the first year, but how you continue to fund the policy. So keep that in mind. And then, like just to finish up with a couple of the other benefits, guys, is use 75 because that's like the last payment, premium payment that I make here. But let's break down some of these numbers at this point. And again, this is just an illustration, guys. This can vary obviously depending on the dividend rates. I'm not really worried about the dividend not getting paid. This company has paid a dividend for 119 years straight. However, the dividend rate can change. So, these numbers could look different, but just as a ballpark here on what, just to get an idea of what it can do, by age 75 here, year 40 of the policy, I put in about 1.1 million. I have access to about $2.8 million in net cash value. I'd say that's pretty significant. $3.5 million death benefit, right around that range. Even if it's not right at that number, here's the thing, guys, is another major benefit we get from these policies is the long-term care protection as well. If you get diagnosed with a chronic terminal illness, some companies provide for specific medical conditions as well. You can get a tax-free advance of this death benefit to help with those long-term care expenses. So, unlike, long-term care insurance where there's a lot of limitations, health insurance, there's a lot of limitations. Not saying not to have those things, but to have this option and benefit in our life, I think is just huge, especially as we get older. We're all going to get older. We're all going to break down eventually. It's part of life. So we want to prepare for that, right? So to me, this is a major, major benefit. I sleep really good at night knowing that, my policy is going to compound tax-free every single year for the rest of my life. As long as I keep the policy in force, I'm going to have this really good death benefit. And this is just one policy, guys. We can set up multiple policies. So anyways, I'll go ahead and wrap up with that. That's kind of the way I set my policy up. High cash value in the first year with the lump sum, 25-75 split, breaks even really quick. It starts growing by more than what I put in every single year. And that's really, for me, when it comes to the infinite banking concept, this is really what we want our policies to look like, or as close to it as possible. So anyways, I hope that was helpful, guys. If you have any questions, leave them down in the comment section below. I'd love to hear your feedback as well, what you think about this type of policy, my illustration. I don't know. Could you have set it up better? Would you have done it differently? I would love to hear your feedback. And of course, if you want to have a conversation about this to see if it's a good fit for you, I'll have ways to get in touch in the description. All right. So hope you guys are crushing it. Hope you're doing well. To your success, Matty Ice is out.